The range just died. For nearly 50 years, silver was trained to fail. $4 on the floor, $50 on the ceiling. Every surge faded, every breakout punished. Investors learned the habit of disbelief. But here's the contradiction. The moment silver looked the most boring, it became the most dangerous. What you're seeing now isn't a rally, it's a structural snap, a shift from slow accumulation into vertical repricing. Momentum that used to unwind over months is now compressing into hours or days. That doesn't signal calm, that signals pressure, stored, coiled, waiting. And this matters to you because when a market exits a half-century cage, it doesn't drift, it escapes. The $100 level isn't just resistance, it's a psychological dam. Once it breaks, the move that follows won't feel gradual. It will feel sudden, confusing, and impossible to chase. But here's the part nobody is saying out loud. Silver isn't moving on its own. Something far larger is forcing it out of position. So ask yourself this: what kind of shock is powerful enough to break a structure that survived for 50 years? What just happened didn't start with silver. That's the mistake most people make. They zoom in on the price and miss the trigger entirely. The real event happened elsewhere, quietly at first, and only now is it showing up in metals. Here's the frame. Over the past year, markets were told a familiar story: inflation cooling, stability returning, normalization underway. But notice what didn't normalize: long-term confidence, especially in the assets that are supposed to anchor the system. What looked like calm was actually suppression, not resolution. The core event you need to understand is this: capital stopped trusting duration. Money didn't just rotate, it recoiled. The long end of the system began to fracture, and when that happens, everything priced on top of it has to adjust, not slowly, simultaneously. This isn't an isolated incident. It's part of a repeating pattern. First, stress shows up where leverage hides best. Then liquidity thins. Then price signals start behaving strangely. Faster moves, shorter pullbacks, more violent reactions to small shocks. Here's the question that reframes everything. If the foundation asset of the system is under pressure, what happens to assets that were artificially restrained to support it? Because that's where this story is actually heading. The claim sounds extreme, but the evidence is already visible. The pressure isn't theoretical anymore. It's measurable. Here's what changed. The paper market stopped matching the physical one. For years, price was set by contracts, not by metal. That worked only as long as nobody demanded delivery. But that balance broke. Large holders began pulling real silver out of exchange vaults. Millions of ounces didn't roll forward. They disappeared from availability. That's not trading behavior. That's defensive behavior. And notice what's missing from the official response. There was no denial that inventories were tightening. No reassurance that supply chains were healthy. Just silence. When institutions act without explanation, it usually means they're reacting, not planning. This matters because paper markets rely on confidence, not metal. The moment participants start preferring bars over contracts, leverage turns toxic. The same structure that suppressed price becomes a trap. Shorts can't exit without bidding against each other. Liquidity vanishes exactly when it's needed most. Now watch how fast this escalates. The system was built on the assumption that most people would never ask for the thing they bought. That assumption just failed. And once it fails, the repricing doesn't wait for consensus. What happens next is never announced. It's normalized. At first, the stress looks manageable: small dislocations, brief spikes, explanations about temporary conditions. We've seen this movie before. In past cycles, pressure like this stayed contained because the system still had slack. Inventories existed. Confidence could be patched. Time absorbed the shock. But this time is different in one crucial way. The abnormal is becoming routine. Faster moves are no longer treated as warnings. They're treated as the new baseline. Pullbacks that used to reset sentiment now barely register. What should feel unstable is being accepted as normal behavior. This is how structural breaks spread, not with panic, but with quiet acceptance. The market adapts to stress instead of resolving it. And once adaptation replaces correction, instability compounds. Here's where the comparison matters. In previous commodity repricings, the break came after supply failed. This time, the break is coming because trust failed first. That flips the order of events. Price doesn't respond to shortages. Shortages respond to price. This is where the story flips. When instability becomes routine, the system stops damping shocks and starts amplifying them. And that's when the next layer gets exposed. The second proof hit is harder to ignore because it comes from inside the system, not outside it. Watch what institutions are doing, not what they're saying. Official pricing is already drifting away from spot. Government-issued silver products are being sold at levels that imply a much higher underlying value than the market admits. That gap isn't a mistake. It's a signal. When a large issuer prices defensively, it's because they don't believe replacement costs will stay low. Now notice the contradiction. Publicly, the narrative is stability. Quietly, prices are being set as if volatility is guaranteed. That tells you expectations have already shifted behind the scenes. At the same time, refiners are slowing everything down. Payments that used to clear in days stretch into weeks. Certain forms of silver aren't even being accepted. That's not efficiency. That's triage. When processing slows during rising demand, it means capacity is the bottleneck, not buyers. Here's the line that changes how you see the entire market. Price isn't being capped by lack of interest, it's being capped by friction. And friction always breaks suddenly. Notice what this implies. If supply can't move fast enough and trust can't be restored, price becomes the release valve. And once that valve opens, control doesn't come back easily. Now the pressure starts stacking fast. First, industrial demand doesn't wait for sentiment to improve. Manufacturers don't hedge emotions, they hedge inputs. Contracts get extended, volumes get locked in. Silver is bought because production stops without it, not because the price looks attractive. That removes supply quietly before headlines notice. Second, processing delays ripple outward. Dealers can't recycle inventory. Capital gets stuck. Restocking slows. What should be a fluid market begins to stiffen, not from panic, but from timing mismatches. Third, liquidity starts slipping at the edges, not a crash, a hesitation. Quotes widen, availability thins, small frictions stack on top of each other until movement itself becomes the problem. None of this feels dramatic in isolation. That's why it's dangerous. Each development reinforces the next. Demand accelerates, supply lags, cash flow tightens. The system doesn't snap all at once. It strains. And here's the question that matters now. What happens if this continues? This is where it stops being abstract and starts touching you directly. When supply chains stiffen, the effects don't stay on trading screens. They show up in everyday decisions. Availability shrinks, premiums widen, waiting lists replace price tags. You don't notice it all at once. You notice it when something that was easy to replace suddenly isn't. What used to feel optional begins to feel urgent, not because of fear, but because of friction. Time delays, extra steps, added costs, small barriers that quietly change behavior. People stop asking whether something is cheap and start asking whether it will still be there. And here's the part most analysis skips. When access becomes uncertain, trust shifts away from systems toward possession, toward control. That instinct isn't ideological, it's practical. You don't need a thesis to understand it. You just need to experience delay once. If this feels familiar, say so in the comments, because once enough people feel it at the same time, demand stops behaving rationally. It behaves defensively. and defensive demand doesn't wait for pullbacks. That's when the pressure you barely notice turns into something you can't ignore. What makes this unsettling isn't emotion, it's mechanics. Systems don't fail because people panic. They fail because incentives quietly flip. The structure holding this market together was built on leverage, timing, and trust in intermediaries. As long as those held, price could be managed, not controlled forever, but delayed. But look at what's happening beneath the surface. Holding paper exposure only works if conversion is guaranteed. The moment delivery becomes uncertain, the incentive shifts. Institutions don't argue, they reposition, they move from claims to control, from promises to possession. This is why accumulation at the highest levels looks calm, not frantic. Central actors aren't chasing upside, they're reducing dependency. They understand something retail rarely hears. When systems reset, access matters more than price. Here's the insight mainstream coverage misses. Stability isn't restored by fixing prices, it's restored by restoring trust. And once trust migrates away from financial abstractions and toward physical settlement, the old tools stop working. That doesn't cause collapse overnight. It causes drift, then gaps, then sudden repricing events that seem to come out of nowhere. The system isn't breaking loudly, it's rerouting power, and that sets the trajectory for what comes next. From here, the path splits, and neither option is clean. In one scenario, pressure is released gradually. Controls tighten, friction increases, access becomes more managed than priced, markets stay open, but movement slows, volatility spikes in bursts, then gets smoothed over. On the surface, it looks like stability returning. Underneath, it's rationing by another name. In the other scenario, release comes all at once. A failed auction, a delivery miss, a sudden rule change, something small but undeniable. Confidence doesn't erode further, it drops. And when that happens, price doesn't search for balance, it jumps gaps. What looked expensive in hindsight becomes cheap in retrospect. Notice the common thread. In both paths, control weakens. The difference is speed. Either pressure leaks out slowly or it vents violently, but it doesn't disappear. This is why the next move already feels loaded. Markets aren't waiting for new information, they're waiting for permission to reprice. And once that permission appears, even briefly, the reaction won't ask whether it's justified. It will only ask how much is left. There's one insight that pulls this entire story together. This was never about silver outperforming something else. It was about what happens when trust quietly exits the system that sets prices. When that happens, value doesn't rise, measurement fails, assets don't become scarce overnight, access does. For decades, stability came from believing someone else would always make the market work. That belief is fading, not in a headline moment, but in 1,000 small decisions to hold, delay, withdraw, or opt out. And when enough of those decisions align, the outcome looks sudden, even if the cause wasn't. So the real question isn't where the price goes next. It's whether the old reference points still matter at all. Because once a system starts repricing trust instead of assets, the move doesn't reverse easily. It moves forward until a new equilibrium forms. And this story isn't finished. The next phase isn't about metals. It's about what else gets revalued when confidence breaks. If you want to stay ahead of that shift, follow this channel. We're tracking what comes next.